Good morning, everybody. I think everybody here understands English, so I'll go to English. I want to make sure everybody understands me. This is joint work with, when you do a research, there's nothing better than to collaborate with someone else. And as you get older, that becomes difficult sometimes. But I found a few people who were interested in the study at around NYU even. One is Professor Andrew Papanicolaou, who is at Tandon School of Engineering, and then two wonderful students, Xinwan Zhang and Xin Yufan, who helped a lot with some of the computations and some of the tests that we will be discussing. So the talk today is going to be about volatility futures. Volatility futures. Volatility of the S&P 500 is something we will discuss. It's tradable. There's an index called the VIX. I assume most of you know it. It's, in Brazil, there have been some attempts to have a similar index by B3, and I hope that B3 does it, because I hope that this talk inspires B3. The people from it used to be called BMF Bovespa in my days. Now it's B3, but B3 should start looking into this, because times you always have to think about new things and new products. And this product has been very successful in the United States. So I'm going to talk about VIX futures. I'm going to talk about VIX ETNs, exchange traded notes, and ETFs. People call them. There's all sorts of acronyms, ETNs, ETPs, ETFs. ETN is because the most popular one is an ETN, an exchange-traded note. You have VXX, XIV, UVXY, SVXY, TVIX, EWZ. Actually, EWZ is wrong. That's the Brazilian ETF. It's called VXZ, not EWZ, but that came in. So I will talk about modeling the VIX curve and applications to trading and investing in exchange-traded notes. Exchange-traded notes is going to be, so the talk is going to have some statistics, some exchange-traded notes, and then I will end also with some remarks about the European version, which is called VSTOXX, the VSTOXX index, which is less known, less liquid, but also very interesting. It's particularly for mathematicians, because mathematicians, once you have your model, give you some confidence that you can participate in this market, because you're already, it's a similar market, maybe a different index. And also, there will be some backtesting results and so forth. So that's what I want to cover. So let me just start by saying the definition of the volatility index. There's something called the implied variance. The options market implies volatility. It's called the implied volatility of an option. But also, it implies, through all the implied volatilities of a series for a particular expiration, the implied variance. So you can actually ask the option market implies how fast it's going to run from the point of view of variance, and it's a famous formula that a lot of people here know. What's interesting is that in 2000, the Chicago Board of Options Exchange created a discrete version of the implied variance using traded contracts, and they called it the VIX. And it's basically a weighted sum of out-of-the-money calls and out-of-the-money puts on two maturities, so that the average maturity is 30 days. So basically, the CBOE built an index, and this index is called VIX, and VIX is the square root of the implied variance over 30 days, and once you build the index, you can build futures on it. The VIX is known as a fear gauge of the market. In the media, people say, wow, therefore, in particular, when VIX goes up, the market typically goes down. They're inversely related to the market. So a lot of people say, oh, the VIX is very high, the VIX is very low. It's in the media, it's every day. It's a way like that, I was thinking a parallel perhaps in countries in Latin America would be what they call the country risk, the spread above Treasury, except that it has a completely different statistical structure. But you could think that if you wanted to see how say, Argentina is doing, you could go and say, Argentina's spread above 10-year Treasury is, for the benchmark bond, is 400 basis points. And then if something good happens, the spread will go down. If something bad happens, Venezuela's spreads are through the roof. and so on and so forth. Well, but obviously the statistical properties are very different, and here what we see is that when there's demand for options by hedgers, by people, by portfolio managers, or the value of protection for downside equities goes up, and therefore you get spikes, and these spikes, this is from the beginning from 1990s, so it's a back thing until now. You see the spikes here. And what's interesting statistically, so if you go into the statistics of the series, you see that if you plot the VIX level, you have a highly skewed probability distribution, which indicates that this is Lehman right here. It's an 80 volatility, and the lowest it's ever been is around 9. And then most of the time, the first thing that's interesting when you do this picture is that you have a mode at around 12 and a half, which is less than the average. One of the things that we will get into it, the first thing that I want to tell you, so there's a lot of skewness. This has practical implications, as you will see, in terms of futures. If you look at the statistics of the previous graph, you have heavy right tail, as we saw, and skewness. And the tail can be fitted to a power law, like a Pareto law. The mode is around 1157. The most likely value, the median is 1763, the average is 20. So the first thing here is that one thing you could say is that from a point of view of, I think one of the talks yesterday talked about that, the volatility risk premium theory. Long-dated future prices should always trade above the average because the average is sort of a long-term expectation under the P measure. And so, the Q measure should have a risk premium. So you should therefore have that there should be, the average should be, the long-dated futures should be at least the average, but also the typical futures, or the typical value of VIX, the value of VIX being the VIX being the short-term futures, usually you expect an upward sloping curve because the mode is less than the average. So therefore, in expectation at least, you expect contango for volatility futures.
Marco, may I ask you, since we have perhaps people a little bit far from the typical jargon of finance, so could you tell a little bit to us the implication to the normal man or to the trader of the person, or what is...
Okay, let me say, that's a very good idea. I want to say that there's something called the fear gauge, like in the morning you turn on television and they said, VIX is 12. What does that mean? For example, when VIX is low, a lot of journalists say, well, this is complacency. It's a very complacent market. Something bad's going to happen. And so when VIX is high, they say, oh, wow, the world is, so this has become, so the main thing that we have to do first is understand what is the statistics of VIX. What is likely, what is not likely. And here we find, because of this skewness, that it is the most likely value of VIX is really low. And it might stay there for a long time. That's the first thing that I'm saying. There's nothing, when you see a low reading of the fear index is low, it doesn't mean that you're going to go crazy and it means that it's low because nothing's going on, because there's no demand for puts. And one of the things that we will see is that this affects the futures curve. And everything that we're going to talk about is trading futures. So what we need to understand is how the market perceives the statistics of VIX and how that involves the trading of futures contracts. And this is the first part of the talk. Thank you for interrupting me. I want to make this very, very, very clear. So it's the point, and this is going to take a while, and I chose this order mostly for pedagogical reasons. So first of all, you could call this stylized facts about VIX. What is VIX? Is it a log normal? Is it a this? Is it that? Is it stationary? Is VIX, you ask yourself, is the VIX a mean reverting process, or is it a process that goes away like a Brownian motion? Or is it a process, like some people might say, that it could have a higher and higher reading through history until something catastrophic happens? So, if you look at, for example, if you look at the augmented, how many people here know what Dickey-Fuller is? Dickey-Fuller is a test for stationarity. It's like the Volkswagen of statistical testing to find whether you have a unit root or not. And what you find in the data is that if you look at the time series of VIX, it rejects unit root. So it says it's stationarity if you look at all the time series. However, it is not clear that over smaller time series, particularly those that begin after the crisis, that VIX is stationary. The meaning of that is that after 2008, we have seen a drop in the level of VIX from that reading of 80. The reading of 80 was a lot of fear. People that were here in 2008, we're talking about Société Générale. Société Générale didn't sponsor anything in 2008 and 2009. They were trying to find out where they could open. They didn't know that they could open, like after Christmas, much less fund a conference. Now, Société Générale is back, everybody's back, but you have to have a little bit of memory about what happened in those days. If you have a reading of VIX in the market of 80, it's not nice. I mean, bankers start asking, throw the towel, call the Fed, send Christine Lagarde to New York, get the money from the Fed, because you have a problem. And that's what happened. And now, you see, so now that means that there's no stationary, because slowly, there's a trend, a secular trend, and this secular trend is the same as the market rising, as the stock market rising in the United States. But now we are coming to an end. For shorter time windows from 09 to 17, does not quite reject unit root. It could also mean that the unit root test of Dickey-Fuller is not the right thing to apply to the time series of VIX, because it's the right thing to apply to an Ornstein-Uhlenbeck process, but VIX arguably may or may not be an Ornstein-Uhlenbeck process. I mean, it's very fat-tailed. But we'll see, maybe okay. So now that I told you about VIX, and that means that the conversation is not closed, there's something called VIX, and VIX is essentially, it is the volatility of 30 days implied by the options market through a formula created by CBOE. And then CBOE created futures. And the futures, essentially, the way they trade is there's a reading. For example, today VIX, let's say, the first contract is 11.5, right? 11.5%, because the volatility is something like, for example, 15% is 1% move a day, so on. So they quote in decimals. The contract is VIX times 1,000. So that means that it's theoretically a vega of 1,000, if you like, to talk about in the lingo. And the tick size is $50. It's 5 cents on VX, so it's $50. The final settlement price is the spot VIX times 1,000. It sells monthly on Wednesdays at 8 a.m. prior to the Friday where options expire. It is a simple, beautiful little toy. There are 9 series open, 9 months open, plus weekly settlements. But the weekly settlements, there's 6 of them. They're not liquid. They're just there. They have no liquidity. So the bid-ask spread is enormous. And so they're cash settled because you can't deliver someone volatility. Here's some volatility. You can take it.
Would that be the square of the VIX? You could have received the portfolio of options?
You could. Exactly, you can. In fact, I wouldn't mind if you give me the square root of the portfolio of options or even the portfolio of options in Vega, But that's right. But so it's cash settled. Cash settled is nice because it means it's cash settled. Even if you don't want to get out of the contract, I think that some brokers will move you into the next contract. It's called the VIX Infinity or something. And if a picture. What does VIX Futures represent? Because that's very important. VIX Futures represent 30-day forward volatility, forward variance or forward volatility. So the red here represents the next 30 days. So for example, today, the 26th or 27th of November, we have 30 days of vol. That's the VIX reading. It's going to open in a few hours. It's going to be around 10, if it was what it closed before. And then on December 15, there's this first contract that goes to January. January 19, there's another contract. February 16, there's another contract, and so forth. These contracts are every third Wednesday. And so this is therefore a way of actually, these 3 or 4 contracts are quite liquid, right? And we'll know why. Any questions on VIX Futures that I forgot to say? It's a futures, like the WTI or like the E-mini, same idea. You have, I don't tell you how much the margin is, you know, or but the broker charges of margin. It's about $10,000, $20,000 per contract. So it's, you know, you can, obviously a leverage product. It's traded at the Chicago Futures Exchange, and you can basically trade that if you have if you're a professional. I don't think retail investors can trade that. Now let's get into the detail of the futures market. The futures market is best seen as a term structure because you have, for example, this is an older, now we're in December, this is the open contract, but this is an old thing because I gave this talk in Princeton at the René Carmona seminar, so I grabbed that. So I apologize for this quite colorful thing. I just took it from the internet, from this website called VIXCentral.com. VIXCentral.com, I don't know how they did this, but they produce a real-time term structure. And you know, I think it's very cool. It's run by some very crazy, strange people. I exchanged Twitters with them all throughout the day. And one guy, well, I forgot his name anyway. But the point here is that in black, you have the closing curve. And at 6:30 p.m., the blue is the new, obviously something happened between the close at 4 and 6:30 on September 14, 2017 that made all the curve parallel shift up. One thing that I think is very important for trading and that good traders look at is the difference between these months, the drop. We will spend a lot of time in that. And also the drop between the first contract and the VIX. This thing here, for example, between this one and this one, you have 12.87%. This is called the roll yield. I think that there was, this is the roll yield. Then you have other roll yields. And then here you have from 11.75 to 10.44, that's $1.30. This is what the difference between the VIX on September 14 and the contract, which will expire maybe December 20th. So in 7 days, either the VIX goes up or the future goes down, right? So there's something that's going to, you understand, there has to be convergence of the futures to that. And also all these guys are going to be moving down. And you notice here the contango curve. Contango means upward sloping. And you see here some kind of fluctuations here, blah, blah, blah. And you know, it becomes flatter here and more convex down here, flatter, little thing here, little butterfly here. And now, as always with futures, it's convenient to look at them in terms of tenor. So instead of looking at the real expirations, you have to look at the tenor. That's the same in forward, any forward contract. The first reflex of the statistician is to change into tenor because now you have a photograph that doesn't change. If you look at this picture, the photograph changes because everything, you know, all the dates change here. But if you make this picture, then you're counting days to expiration. This is the first thing that a quant in term structures does. And then I connect it with a pencil, not a pencil, but I connected with VIX. So this gray thing here that connects the purple dots is the term structure, what I call the CMF curve, the constant maturity futures, because every day you'll have the 30, 69, and so forth. These green things are the weekly contracts which you should disregard because you see they're completely out of line and they're not liquid. No.
But Marco, yeah, maybe we have to distinguish between the relative maturity, the tenor you mentioned that we see on this graph, and the one we had before in absolute dates, because actually this sort of a little dip in the curve at the 90 days corresponds to a December effect, which is a calendar effect which will move along the tenor thing. And it's due to the fact that you have less. So the December effect, it's due to the fact that the December contract settles on something like the 21st of December.
On the 15th.
Oh yeah, maybe. But anyway, it is covering the 30 next days, which with a lot of holiday. Yeah. So systematically it's there. And I think it's important to always sort of filter out this December effect before doing any PCA or something like that.
Yeah, I remember. Yeah. Well, I mean, yeah, it's a good idea, yeah. No, absolutely. I'm a student of you, and you told me this before many times. I will continue now. Right, got to be careful here. Yeah, yeah. The point is, can I make money from this or not? I still don't know how. Well, I could sell December, but it's already low, so because everybody had the idea before.
The market is already pricing
yeah,
it. Yeah.
okay. So that's good. So now we're going to talk to the French. The French are happy. We're all happy because something was very bad could have happened. It didn't, right? And the bad thing was that a woman from Marseille would win the French presidency, called Marine Le Pen. And if that happened, then we would know what would happen the next day. France could leave the Union, no more, I don't know, whatever. So this is the effect that had on the first round of the election. And now you see a different curve. This is called a partial backwardation. So it is on relative time. It's on April the 17th, with the future almost near VIX. So you see a reading of VIX, let's say of 15, from 10 to 15. That's a 50% increase in the VIX in a few days. With this whole European business about all things European and British people leaving the Union and everything, and the French, deciding, experimenting with the 1930s policies and everything, we find that worries the market, even the Americans, because this is American markets. So we're worried because Europe is a trading partner, because a lot of French banks and European banks have connections with, and we have exposure to Europe, and the rules that bind us together as trading partners might change dramatically. And this is what it does to our little market of VIX. Although we knew that the probability was low, you can never discount that things would happen because they happened in England. So if they have, but England is nothing compared to France leaving the European Union. We all know why.
In the US.
Well, yeah, I'm a US-based person. This is the dollar VIX. But that's fair. I don't know why you say that. No, yeah, if France leaves the European Union is finished. If England leaves the European Union, first it's not going to leave, but if it leaves, no one cares that much. We thought we cared, but we cared for a week. But if France leaves the European Union, then the European Union is finished. Because the European Union is really Germany and France. That's my own personal view. Please don't. Now, if you go after the French election, then this curve on April 25, 5 days later, it recovers contango. I don't know where the VIX was. I made a mental, it's still not at 10, probably around here. Why? Because this contract here, this one became this one here, this one became this one, you see? And I forgot to put the VIX because VIX Central doesn't have the spot VIX on the tenor thing. But I would imagine it's still perhaps either flat. Going to the election, the curve flattened. The curve flattened, and when it flattens, you get a bit scared. Because what you really want to see that there is no fear in the market is a relatively low reading of VIX with concavity, with normal contango. In our business, it's normal to be in contango. This is not normal. This is a cause of some concern for the market. Now, the extreme reading of the VIX future curve occurred in the week of October 16, 2008. The reason I'm doing that is because I want to give you a feel for what this market is, for what you look at, before we put mathematics on the board. Before you put mathematics on the board, think about this as a wave, You're in Ipanema, you're swimming, everything's fine, There's little waves, and then all of a sudden you see like a bigger wave coming. You say, maybe I should get out of the water, take the kids out. And then maybe you see like a tsunami coming, and that's this. This is the tsunami of the fear gauge. It's a reading of 60 on the front contract. I already told you that VIX was at 80, and this is completely backwarded. But 2 months later, you see that it's become flat and lowered by 20. So this market is very, very volatile. As we saw yesterday, Monsieur Guillon, he said that he calibrated at 200. the front volatility. It's about between 100, it's 100. The volatility of the VIX or the VIX contracts is 100%. If you have to pick a number, it's 100. That means that it's right now 10 times more volatile than the S&P 500, right? So this thing is like a wild horse, and then it calms down in the future, because in the future, market makers just look at expectations and so forth. They add a risk premium, so 20 so it was 20, it's going to go to 25, because you know that no bad thing can last forever, right? So this is, we were here, we're still here, we survived that. I'm a survivor of 2008, yeah. You too.
After the French election, the VIX went from 60 to 11, basically.
Exactly. And so the people who, for example, sold the front futures, they made a lot of money, right? If you understood that you bet that Marine would not be elected, what would you do? You would sell the front or the second futures at around 16, 17, and then go all the way back down to 12. And if you look at it on a leverage one basis, that's 50% profitability. But of course, what if Marine won? In fact, it wasn't even Marine. It was Macron versus Fillon. That graph that I showed you was the first round. Once Macron won, it was over. We didn't care anymore. The market didn't even move. You know, Le Who? No. It was about Macron versus Fillon. Because if Macron didn't pass, then Fillon was so hated in France that we knew that Marine Le Pen had a chance. And that was the concern. Very, very subtle, with a bunch of futures expiring and VIX. So a lot of fun, you know, to be had, if you like. You know, the fear was there. It's a fear thing. Now, summarizing, conceptualizing, we have something called the risk on, risk off, or the VIX future cycle. You know, these words are television words. I like to do math finance that uses television words. I don't like to do math finance with the opposite might be with, I like to do math finance with anything, but risk on, risk off, how many times do you get a math finance talk with risk on, risk off? Okay, so let's start here. You are here. The market is trending and quiet. Risk on. Why risk on? Because buy the S&P, buy the Euro stocks, buy the techs, get into the stock market, because the stock market is quiet and it's trending. We like it. Volatility is low. VIX term structure is in contango. There's nothing bad going on. No one wants puts, a lot of puts. Then the possibility of the market becoming more risky arises, and the 30-day S&P implied vols rise. There's demand for puts. Maybe there's demand for puts somewhere, so the vol rises. Then we get into a risk-off mode. Take the money out of the market. VIX spikes, CMF flattens in the front, then curls up, and eventually goes into backwardation. The wave rises, right? The wave rises, and then backwardation is usually partial. Even with the French election, backwardation was partial. And CMF decreases only for short maturities, but it can be total in extreme cases. The end of the world, it will be backwarded, yes. And uncertainty eventually resolves itself. The CMF curves and steepens. Risk on comes back. Then the most likely state, contango, is restored. That's the end of the cycle. And then repeat it again the next time you have some news. All right, so this is the cycle, risk on, risk off. This is what we trade. So how are we going to try to get some statistics on this? I already told you what happens. There's a beast that is sleeping, something happens, an election, you know, generally now it's political. You know, the Fed was a big cause for moves in the VIX, you know, leading into the first rate hike. After the first rate hike, people sort of calmed down. And then also around the tax voting now at the end of the year with the American Congress, around Korea, around things like that, there may be some events there. Earnings of big tech companies. So again, we go into the constant maturity futures, and the constant maturity futures, I will define it here to be a linear interpolation. Although everybody in this room can do a better constant maturity futures than interpolating linearly, for the sake of this talk, let's assume that it's linear. And I have a reason for that too. Then you can do a PCA to quantify CMF fluctuations. So a PCA is basically, like, it has some interesting aspects. Basically, you try to do a statistical model where you look at the logarithm of each constant maturity futures. The dates are 30, 60, 90, 120 every month. And you have the average of each reading. So you put everything on a constant maturity futures frame. There may be some noise because of the December effect, whatnot. Let's ignore that for this talk, for now. Let's just ignore it for a minute. It's going to be very noisy, right? But let's make this experiment. Why? Because we can do it. And then we look at some sort of orthogonal decomposition of the fluctuations, not of the fluctuations, of the departures from log to the average, from the log of any particular date. So I have essentially all the dates from Feb 18, 11 to like 5 years worth of data. That's the data that I could grab. And then I have this little thing. So these are eigenvectors of the covariance matrix, of the difference between this and this. And when you do, there is a lady that has worked a lot on this, Carol Alexander. A lot of you know her, I imagine. And Corovillas, they wrote a series of papers. Although it's not exactly the same PCA, it's in the same spirit. We're trying to understand how the futures and volatility move. And what you see is that there are a bunch of, the first is the biggest, the second, so forth, so on and so forth. Now I want to bring to your attention something interesting. Do you have any questions here about the PCA? There is a question to ask, but you're not asking it. So, okay. No questions? Yeah.
PCA is always weighted.
Okay, no, that's not the question you have to ask. The wrong question.
I have...
No, it's the wrong question. The question is, why do you do PCA from the average and not from the log returns from one day to the next? Ask me that question. I do it. Why don't you do...
My other question was, which average are you taking? So that I understand.
I take, no, I have to, you underestimate my sophistication. You know, I have no sophistication. I take the average. I mean, there might be another average, but the average, you know, one.
Marco, is it a time average or is it an average of the futures across the...
It's a time average.
A time average.
Yeah, so what I do is I look at, very good. I knew there was some good questions. I knew there were some questions. So once you put the standard maturities, there are 8 of them, as a matrix, you can average down. Imagine the futures are columns. You average each column, so you have the average position of each futures. You know already that the long dated, it's 20 for the VIX. Every future is going to be there. And then you look at the difference between the average and everyday reading. And you do a PCA on those differences. This is slightly, excuse me for the redundancy, different than having a PCA from one day to the next. Because when you do a PCA from one day to the next, you really, first of all, you're going to get much better definition on the first eigenvector. Here, you're going to look at contrast from the mean. Contrast from the mean makes sense if you think there's some sort of mean reversion or a stationarity. And the results that you get are best understood. So you get the usual eigenvectors, parallel shift, and so on. But what's interesting is that, for example, the first PCA weight, you can project the curve on each PCA. And you can look at the histogram of how much the curve loads on the first, how much the curve loads on the second. Because now, let's say it's in sample, but the eigenvectors are fixed, but every day, you know, you load a little bit. And so you find that the first one has a negative mode. This is a signature of the fact that you have skewness. You have a negative most likely value. And then the second one is centered. So now that means that if I represent this by just taking the most likely mode for each eigenvector and assuming no correlation. I think this is kind of a very cool calculation, a physicist calculation. Then you find that the most likely curve is this blue curve here. The most likely place to find the curve, the VIX, is 13.5. I would say, depending on the data, it could be 11. And the most likely place to find the 7-month is at 18.7, 19, 20. That means that when you wake up in the morning, or where you're in the middle of the day and you turn the television on and they say, my God, VIX is at historically low levels. Something is going to happen. You should take this blue curve and say, where am I in Marco's blue curve? Because if you're close to Marco's blue curve, then you're going to stay there until something else happens, because you are at the equilibrium. You are the most likely position of the curve. The most likely position is contango, concave, and with pretty big drops here. From 0 to 1 month, there's a 15% drop. And from 1 to 2 months, there's a 7% drop in the most likely state. What does that mean? It means that for example, it means that if you consistently sell the 30-day futures, right, and let it expire, and you hope that you're going to stay in the most likely state, you make 15% a month. So that means, how much is that a year? It's like something like 200% a year. Of course, you can't do that for free because the world is not going to stay there. The world is going to change. So we have to, you see, so there you see there's a monetary implication. Whoops. There's a monetary implication of this contango. So I have so far taken a curve, put it in a constant frame, applied PCA, found the most likely state. I tell you that the most likely state is in contango, and I obtain numbers that tell me more or less up to 10% error, let's say, what the position of the curve is in the equilibrium state. Now, if you do this, because here there are people from commodities, if you do this with petroleum, or you do this with nat gas, electricity is a different business. That's why I asked Professor Cartea what to do, and he said, well, take a look. In oil, stocking a barrel of oil costs $1 implied by the futures market. The difference between spot WTI and 1 month WTI or 2 month WTI is between 80 cents and $1 on a $50 barrel. Now, if I do this in my head, back of the envelope, that's a 2% contango. So if you put here the oil curve, you would see something flat, completely flat. This is not oil curves, and why are the oil curves flatter than the VIX curves? Does anybody here want to tell me why? Just why? I think Alvaro Cartea knows.
Carry arbitrage.
Carry arbitrage. There's absolutely no carry arbitrage possible here. So we little people, like Cartea would say, speculators, we are here, we're here to eat from under the shark's mouth, whatever falls out, to try to replace a carry arbitrage by some positioning in the volatility futures market. We are the carry arbitrage, or maybe someone else is. And if there's someone else that is less intelligent than I am, I want to know who that person is. I really do. Because maybe he can help me do something. So he or she or them, right? So there's an absence of storability. To carry oil, you need Cushing, Oklahoma. You need a tank. Or you need a boat in the North Sea if you're European, or gas. But to carry volatility, you either have to have genius people from Societe Generale who do arbitrage with options, but it doesn't work, or you have to get into the futures market. All right, so now this is the first part of the talk. I hope I have told you a lot about futures and it got you all excited. The main thing that you have to be excited is that these contangos are giant contangos. They're not contangos like oil or gas or gold. Gold, you know, you go and you put gold under the bed. How much does that cost you? Nothing. You need maybe to have a nice house with a guard, but you have to pay the salary of the guard to keep the gold. It's not that much. Now we are going to go to ETFs and ETNs. So this is very, very important And I think that Brazil has recently modified their rules to have commodity ETFs. When I was interested in, when I looked carefully at the Brazilian ETF market, you had two ETFs, and they were following, one was following a basket of stocks, the other one was following Bovespa, and they were basically just stocks that were sitting somewhere in a custodian, and that's what you had. And then there was a series of demands for more product, and then commodity ETFs started. The problem with commodity ETFs, as some of you know, is that commodities are hard to store. So the futures market comes in extremely handy. And in this sense, you can think of volatility as a commodity, right? You can think of volatility as buying some sort of protection or risk premium. So there are something called the ETFs or ETNs which track VIX. I gave you the list, and they track a basket of futures contract. So if you look carefully at this equation, it says that the percent change in a day is equal to the interest rate, because in the futures market, you put all the money in an interest account, plus the return on a portfolio of futures. And if you write it like this as a percentage, then this is a fraction of dollar that you have in each future. This is the way math finance people would write it. One more equation, if you want to normalize the weights, the sum of the weights is beta, where beta is called a leverage. For example, if you're unleveraged, you would say beta is 1. That means that my dollar stays in the account, but I buy the equivalent amount of futures. But for example, you could have leverage 2 or leverage minus 1. In this talk, I'm only going to talk about leverage 1 and leverage minus 1, right? And only, so you have this basket of futures. And now we have to do a little bit of bookkeeping. This bookkeeping is the rolling business. So what is a fund going to do? How do they pick their A's? Well, this is the idea. You want to keep a target average maturity. You want to keep the maturity target. So you want to offer a fund that has exposure to the commodity with a fixed average maturity. Let's say the most popular is 30 days. You could have one that has 150 days and so forth. But here, for example, we could have, so you assume that beta is 1, and let BI be the fraction of the total number of contracts invested. So that means the contract on future I divided by all the number of contracts. So this is very easy because it's a fraction of dollars times the total amount of assets in the fund divided by the price of the futures contract. So this is the definition of BI. And then the normalization to have a target average maturity is that the average weighted, the proportion of futures times the tenor should be equal to a fixed number theta. And this gives you an equation for each B. So now every B will move. And if you only have 2 contracts, then if you only use 2 contracts to roll, there's only one choice for B. And that's what creates most of the ETFs. For example, VXX has a maturity of 1 month. It's long VIX futures with daily rolling. So the B is based on 1 month's constant maturity, no leverage. It says these are the weights that maintain a constant maturity of a month. BT is this, and then 1 minus BT is the other one. The way the formula works is that return on the index is cash plus the fraction of contracts times the change in the contract, 1 minus the fraction times the change in the second, divided by the total, by this average of these 2 prices. And so this is the evolution with this equation. This gives you what you might call a stochastic differential equation for the evolution of the 1 month VXX contract. And you can read this from the prospectus. There's a prospectus, issued by some bank, Credit Suisse or something like that. It gives you exactly this, sorry. So, very good. So now, let me make a few observations. This is, by the way, not the easiest way to derive this, but it's intuitive for a trader. The weights actually correspond to a CMF, exactly to a CMF. So the way you calibrate these weights, there's no dividing here. It's dollar weighted. See, the weights that create the maturity create, when you apply them to the price, the constant maturity future by linear interpolation. Therefore, if I take the Ito-Tanaka differential, or whatever you want to call it, what you get is that the change in this is the change due to the futures plus the change due to the rolling, the change due to the weights, which is a derivative, but the derivative is -1 or +1. You have to take the derivative with respect to t. It's a constant. It's 1 over t1 minus t2. So you put it back here, you divide by v, and you obtain that the change in the constant maturity futures looks like this, plus a term which involves the drop in the futures from the second month to the first month. And we reinterpret that by saying that the change in the, so this provides a link between the index and CMF equations, which says this: the logarithmic derivative, or the return on the index, is the change in the constant maturity futures minus this, and this turns out to be the logarithmic derivative with respect to term of the logarithmic derivative of the curve. So it's a slope. So it says the change in the value of the ETF is the relative change in the value of the constant maturity futures of 30-day minus the slope at 30 days. There are easier ways to derive this if you're in math finance. It's just making the switch from tenor. You know, when you make, if you write down from, like in a Heath-Jarrow-Morton parametrization, if you pass from a constant maturity to a tenor, then you have two derivatives to take. Raphael knows this probably better. He taught it to me when I was a child, more or less. So it means, but this equation is very interesting because it's very clean, and it brings about the volatility, if you like, of the constant maturity futures, plus the slope of the term structure, the contango. Volatility and contango. If you own an ETF, you like volatility to go up, but you don't like, but you hate contango when it's positive because it's going to make you lose money. And so this is the equation. For the negative leverage, you get the same equation, but the signs changed. And if you like, the easiest way to explain the behavior of these things is that in order to maintain an average maturity and leverage, funds must reload on future contracts. As you roll, since the future constants drops, we're going to keep a constant amount of capital in, leverage, you will need to reload on futures contracts. Therefore, you reload, but you lose that value unless something happens in the market. Hence, under contango, long ETNs decay and short ETNs increase, right? And this is what we're going to try to understand, right? So are there any questions about ETNs? Is this clear? An ETN is a fund that rolls futures. When you roll futures and you have contango, which is the most likely state, you lose money by rolling. And if you're negatively leveraged, you make money by rolling. That's pretty much it. But you're exposed to volatility, and volatility is high. And so what happens? Well, if we forget that for a second, and this is the most mathematical slide of this conference, what you do is you can actually integrate that as the explicitly. You know, despite the fact that there's quadratic variation and everything, you integrate it, and then you get this magical formula for me that says that VXX today minus VXX in the future discounted is like VXX today times 1 minus the ratio of the constant maturity futures times the exponential of the logarithmic derivative. So it means that, for instance, this term is this thing, if this, for example, goes to 0, then, you know, then this goes to 1, it means that VXXT goes to 0. So, and also on the opposite. So if VX, for example, if you wanted a mathematical framework, if you had a mathematical model that says that VIX is stationary and ergodic and the expected logarithmic derivative is positive, then buying and hold SIV or short and hold VXX produces sure profits in the long run with probability 1. So it's the surfer trade. I take some money that I borrow from my rich uncle, I buy XIV, which is a negatively leveraged ETF, and except for $1,500, which I invest in a ticket to Rio. I come to Rio, I get, you know, I buy a surfboard, I surf, I wait for 5 years, and I come back, and I'm rich. You know, it's a great way, right? I'm not giving this as an example, because there could be some volatility in the middle. So that works only if you never look at the market. And if you never get a margin call, well, you don't get a margin call if you're long VIX, XIV, but some things could happen. For example, they could close the XIV fund. So eventually you'll have to look. Yeah.
There are some, those exchange traded funds, ETF and ETN, on the VIX who have an extremely strong negative trend.
Mm-hmm.
It's perhaps minus 20%
Mm-hmm.
on a very consistent basis.
Mm-hmm.
So how come we cannot short them? And I think that's what you're explaining here. That even though if you buy them, you lose money.
You can short
by
them.
shorting them, we
I already saw it. If you short and hold VXX, you make money with probability 1. You like that? That's a theorem. Théorème. Okay. Now, the difference between a theorem and practice, let's look at the graphs. You're a graph ahead of me. This, for those in the back, this is the graph of VXX since inception, adjusted for 5 splits. It starts at, I don't know, $5,992, and it finishes at $10 or $20. This is in the course from February 2009 until today. So February 2009 until today, we're talking about what, 8 years. It went from 2,900 to 20, right? In that process, some things happened though, in the world. There was a Greek default, there were flash crashes, a government downgrade. If you zoom in, like Raphael was saying, over the last 2.5 years, you have the Ukraine war, yuan devaluation, Brexit, Trump election, Korea, but you see that it's steadily going down, but it does have a lot of volatility. And this is why the borrowing costs are only 3%. You can short this there's a lot of short out there. No problem with shorting. The problem is not shorting. The problem is volatility. Or the problem is your mind, that you think something bad's going to happen. What is the problem? Well, let's go more. On the XIV, which is a reverse, this is the graph. XIV is less liquid. In 2011, well, right now it went from nothing from 13 to 89. So this is real. This is taken from Yahoo. You can actually do this yourself over, when you get home or tomorrow. You can get these graphs, they're there. So, yeah.
Question about terminology. So TXX and XIV is what you would call ETF or ETN.
They're ETNs. You know why?
But at the same time, they are investing in.
Yeah, but no. Here's what happens: is that that's a very good question, and actually, it's a very Italian question, because you have no idea. I know why. Because these were launched in 2009, and they were launched, and we had a talk in Rome. There was an ICBI in Rome, and the people who launched it gave me an explanation in a seminar on volatility in 2009, which is the launch. That's why I say it's an Italian question for me. The idea is that Credit Suisse decided not to go directly into the futures market, because these are smart people. They decided to use their own trading desk and to issue a note which expires in the year 20-something, maybe not too long, maybe not. So these notes are essentially, they operate like they are total return swap, if you like, where you basically buy the note at par, and then you get all these P&L coming from the future strategy, and then at the end the note settles at par, and what the Credit Suisse does is it collateralizes that note. It puts some money from the money that, because futures don't cost too much, they can actually put a bond, like for example a U.S. government bond, in escrow in case they go belly up. The ETF can pay the investors. So it's a derivative. It's a big. It's a financial engineering solution called an exchange-traded note, and so it's that for the Brazilians out there, especially for B3, that is listening in the back, I hope, you have the choice of doing this as fundo de índice que segue futuros ou uma nota estruturada. That is, that there's a Bank Itaú, that says, I'm paying you the return every day of this futures basket. And then how Itaú hedges is none of the business of the investors. They hedge probably going to the futures market. That's the difference. Whereas the ETF, it's a more, you basically have a mandate. For example, they might say, well, what do you do with my money? Well, I go to the market and I do this and this and that. Also, the other thing is that people were concerned about front running. The people who issued this, the Credit Suisse traders, they were afraid that if they wanted to follow the daily roll, but they didn't want to tell people that they were going to daily roll. They might have a way of hedging using swaps that would make it harder for the market to pick on them. So, and then another reason is that banks usually have a lot of bonds that they don't care much about, so they're happy to collateralize a profitable product by putting some bond in escrow and, and using that collateral, taking it off their balance sheet also, because there were a lot of bad bonds in 2009. So you put it somewhere and you say, look, this is collateral, it's not longer mine. Oh, great. So there you go. That's a good question. ETN is when it's a note and your credit risk is the bank. ETF, the credit risk is not with the issuer. The ETF is kind of, it's a slightly different thing. It's a matter of okay, fine, sorry for borrowing, I hope I'm not. So now we have to model. We have to do a model because, why do you have to do a model? You have to do a model because, as Rafael said, I just told you you're all going to be rich. Some of you are going to be, others are not. But how, the point is, how does this investment, shorting volatility, compare to, say, buying the S&P? I mean, you know that buying the S&P is profitable. If you wait, it has been, will always be profitable. You may have some years that you don't make money, but, you make 5, 6, 7%, 5%, 6% a year. That's money, right? So you have risk, but you make money. So how much money do you make by this? So in order to quantify this, I use a model, and this is and this model is going to be not a one-factor model, it's going to be a two-factor model, and it's going to have some mean reversion, and it's not going to be very fancy, because if it's very fancy, then I'm not sure what I'm doing. I have to come up with something quite unfancy. This is the second part of my talk, is how do I quantify any profitability from the ETFs? So enter now mathematical finance, Julien Gouillon's territory, which is, two-factor volatility models, except that here I'm modeling directly the VIX. I'm not modeling stochastic vol, I'm modeling directly the VIX as if the options didn't exist, let's say. As if I was a Martian or an Argentinian that came and found this curve and said, I want to trade this curve and I know nothing and I'm just going to trade the curve. And, but of course, if you wanted to trade the curve and the S&P options, you'd have to go back and do what Julien Gouillon was doing. But I'm just focusing on a little piece of it. But I can take it a bit further. So basically, you have two processes, and you have a correlation, very simple stuff. X1, I think it's probably going to be driving the VIX, and it's going to be a slow mode. X2 is going to drive mostly the slope, and it's going to be fast. And the factors should be positively correlated because, the fast mode gets excited once things curl up. Once Marine Le Pen appears in the picture, that's what happens. First ball rises, then it curls up. So here's a cool thing. You use a Q measure to model CMFs, right? So here's the idea. The connection between the VIX and the constant maturity futures is done via a Q measure. But you also have the P measure because you're like doing P measure. You're a P measure jock. You have the P measure. That's what you have, the history. So what happens is that you have to, so this is, when you use the Ornstein-Uhlenbeck process, as Álvaro Cartea said yesterday, then the market price of risk results in new renormalized Ornstein-Uhlenbeck processes, so you have a closed form solution. So overline parameters correspond to Q measure. Non-overline parameters, like these, correspond to P measure. And assuming a linear market price of risk, the risk factors are distributed, we already said that. An estimating model means simultaneously, at the same time, finding the P measure and the Q measure through history. So because I have a futures, what do I know? I have to glue them together. So I have the VIX like running like a little horse. I have the VIX Futures. You know, the VIX Futures are the expectation of the VIX, but they're the expectation of the VIX under the Q measure. So I have to have a Q measure, so I have to estimate the P measure and the Q measure every day for my data. And also another remark, this, also you could say, or rather this is a hidden Markov model because I have a VIX, but it depends on two things. What are these things? How do I see them? I don't know. It's one of these models that you have hidden, you have an unobservable variable. If something is unobservable, the common sense says you have to use Kalman filter. That's why Kalman filters in finance are so popular. Because whenever you want to be serious about modeling in finance, you have to model with hidden parameters. Otherwise, you're going to do log normal all your life. You're going to get old doing sigma mu stuff. You have to model additional factors. Well, how do you get those? Well, the statisticians have created a whole machinery, and it's called Kalman filtering, and I am in no condition to teach you Kalman filters here. I'm sure many of you know Kalman filters much better than I do. But this is the technique. So if you use a Kalman filtering approach, you know, and by the way, when you do statistical estimation, according to the criterion that you use, you will get many different solutions. Let us not be, this is not estimating, you know, the diffusivity of glycerin. This is estimating the rigidity, if you like, of a futures curve. And that depends on the data, it depends on your maximum likelihood estimation. But what you can do, if you're really serious about it, why would you be serious about it? Because you want to make some money. You can try it with different methods, with different people doing it, not telling one person what the other person got until after it's revealed that you more or less have the same answers everywhere, so you think that the model is estimated correctly. That's the way that quants work. You know, you have to do a little bit of statistics and a little bit of finding out. And here's what you find, that if you use, for instance, post-2008 data, so 11 to 16, you see so there are a few things that you see. Mean reversion is really is lower for the first mode, so it confirms that thing. Volatilities are similar. And then you also have the renormalized guys are a little bigger, but not that bigger. They're the same. It's like the Alvaro thing yesterday. They're comparable. And a correlation of 44%. If you use data, if you use different data periods and so on, you always see a very fast mean reversion for the second component. A lot of volatility. Volatility 90%, 50%. Definitely vol of vol is 100% animal. Vol of vol is not for children. And it's never gonna, you're never gonna be, if you sold it, you're gonna have to eat some, you know, do some yoga, you know. And if you're long, nothing's gonna happen because we know the most likely state is very boring. If you estimate from 2007 to 2016, because of those spikes and because of 2008, you find, depending on the number of futures that you put, you find the same large volatilities, a little bit less mean reversion if you look at all this data. But you know, depending how many futures you put. Here, if you put all futures, here if you only put 2 futures, you get more mean reversion. So therefore, we're not doing this with laser accuracy, but we're looking for stylized facts, and we're looking for confirmation that these are, you know, that there are 2 components. Yes? Absolutely no. I am using just VIX futures. I am a VIX future jockey.
Doesn't the option market give you more information on the risk future?
Let's suppose it, yes. Suppose it did. So what? What do I do? Okay, I know a few things, okay? I know that the VIX formula and the VIX will work well on paper, but in practice it doesn't work well. Second, I know that the main effect is rolling. The main effect is that if I take a VIX, if I have a second or third future, what basket do I choose? Where is the spot? What do I center? So I start with today's spot. So as the market moves up or down, I'm supposed to roll all the puts and the calls in the, and then go back and buy them again. And I know very well, because I trade a little bit, more than I should, that doesn't make any money. That actually is a way of, for sure, of losing money. So I'm trying to do things that actually are useful for me. And what's useful for me is, yes, to understand the options, but not in that way. In a way that we can discuss later in the Q&A. It's connected to, but the difference between the math and the trading is that you have to conceptualize the math to get to the trading, because you can't do all the trades that the math says. You just can't. Unless you are Goldman Sachs and you have a room of people that do that, and you have all the liquidity in the world, and you pay no transaction cost. And I pay $2 a contract or $1. I pay way too much money to do this kind of stuff. So I have to come up and touch it the least possible and get the most money out of it possible, and then run away, and hopefully spend it in something productive, right? Like a trip somewhere, or a vacation, or a new car. I cannot, or pay the bills that I owe, but I cannot spend money in too many options unless I'm sure. So calibrating to things that actually arguable, but there's a lot of stuff, contango has a lot of information, and if you put a full volatility surface, I mean, Julien took 2 hours to tell me how to calibrate one panel data. I calibrated 5 years of curves in the Q measure. So yes, I sacrificed the options. I never saw a person except Heston try to calibrate the whole movie. And he, no one understood what he got at the end. I don't think he understands it either. Yeah.
Yeah, I just wanted to tell you about what VIX option can tell you. For instance, the smile of VIX option.
I know, I'm not talking about that. No, let's not get into VIX option. I love VIX option. I'm long 50. I'm 50 calls long for December. No, I know.
So typically that will tell you, you would like maybe a model where the volatility of the VIX is larger when the VIX is larger. Which is, I guess, not.
The volatility of the VIX is larger. It is, kind of. Well, oh no, the skew. You want skew? Yeah.
No, I mean that can help.
No, hey, you know what? There's always next year. I do, there's always next year. But the point is, I got a call from the top guy. I gave a talk in ICBI, and I got a call from a man that I'm not going to say his name. He's a very important hedge fund guy in Chicago, with 2 French quants listening in, for me to tell them how to trade VXX options. So what do I get from that? Is that no one that I know knows how to trade VXX options. So VXX options, the VXX smile, good luck. Good luck. I trade them too. What makes more money, VXX options or VXX futures? Or VXX ETNs? I tell you, first VXX ETNs, then VXX futures, then VXX options, if lucky. Yeah.
Something that has been bothering me is that since last year, the volatility of all markets, they are going down, and specifically the VIX futures, they are like the 5% lowest levels of the last 20 years.
Yep.
And I would like to know if this methodology that you develop, it captures this downward in the vol, if you estimate different.
Let's wait a while, because I have a lot of things to say, and I think this will address that. What you're saying is that people look at the low volatility and they say, well, there should be a mean reversion signal somewhere. It's going to go back up, right? That's what you're saying. Oh.
I don't know. It
I mean,
just puzzles me.
Look, no, you can actually look at very fancy models of the skew, how the VXX options will inform you about vol. I'm all for that, but if you don't understand this, you won't be able to do that. You have to understand this first.
Yeah, let's forget the option, and I just would like to make sure I understand this, because from historical data, you get both the P parameters and the Q parameters.
Yeah.
So the mu1, for instance, and the mu bar 1. Can you tell us how you get each one of them?
That you ask Andy Papanicolaou. But there's 2 things to do. First of all, first of all, you estimate the kappas using a correlation matrix, because the kappas inform about the, no, I mean, I'm an honest person. I'm not going to sell you stuff that, I believe in this. It's like, like I believe what they said, you know, the women, I believe in them, right? I believe in the senator. No, I don't. I believe in this stuff. Now, I believe in this stuff, but I'm a mathematician, so mathematicians are very skeptical of statistics. Now, this stuff has Kalman filter. Yes, we are. We think statistics is, we were trained to say that statistics is not provable, therefore. Here's what you do. You look at the correlation matrix of the futures, you fit it to this model, and you get easily sigma rho and kappa bars, right? You get the, then you have to go back and look for the means. And what's important is the difference of the means, mu1 minus mu bar 1. I will tell you how that enters in a very specific way monetarily. So the answer to the question that I get is that the mu's, the difference between, if the mu bar is equal to mu and kappa bar is equal to kappa, then shorting ETFs makes no money because ETFs are martingales. You see, if there is no difference between the risk neutral measure and the non-risk neutral measure, selling ETFs has zero expected return because the ETF, being a tradable strategy, must be a martingale under the risk neutral measure. So if the risk neutral measure is the measure, then there is no P&L. Fortunately for us, the signature of that is the difference between kappa bar and kappa and mu and mu bar. And this is how we came to it. So part of our results, and I thank Bruno for this, is actually, you know, the difference here, mu1 should always be bigger than mu bar 1, something like that, you know, whatever. There has to be an order there, but I will show you in the equations. So when I take this equation, which is the universal ETF equation, and I specialize it to the model that I told you, let's call it the Bergomi model, shall we, for Bergomi. Then what you get is you get an equation for the ETF. And this equation is constant volatility, guilty as charged, sorry, you know, I'm going to beat myself up because, you know, but it has less volatility for as the curve as you go up in tenor, right? So long-dated ETFs are less volatile than short-dated ETFs. And then you have this wonderful term which is proportional to the risk factors, and that here's the difference between the kappa bars. If the kappa is equal to kappa bar, then the risk factor doesn't matter. And then the other one is mu. So if you take the expectation of this under the equilibrium measure, for which the expectation of xi is mu, you get this beautiful formula that says that the equilibrium local drift is the difference between the risk neutral and the P and Q drifts, and this is how you make money. If this thing is negative, shorting ETF makes money. If this thing is not negative, shorting ETF may not make money. It may still make money, but not according to the model. It may make money because you have conviction, but for the model says it makes money only if this thing, it is what it is. And this is the vol, blah, 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 so you can do sharp ratios and so forth, right? So what I did is I created a model. I said, hey, I'm going to get rich. So before I actually try to get completely rich, because being rich is bad, I prefer to be poor, why don't I do a model? And then check with my model to see how rich I would be, right? How much is this thing giving me on a model? What else can I do? Run it on Martian ETFs. I already used all my data. Martian futures. So what I did is I did the excess return. Oops, sorry. We did here the excess returns, right? How much is the annual return above the risk-free rate, the volatility, and the Sharpe ratio. So now this becomes much more civilized. It says you make between 30 and 56% a year by shorting volatility. You're making money like a bandit. The question is, what's your appetite for risk? Because your volatility is going to be 100%. Or let's say, if you're lucky, 65%. So here you get the performance. And the performance since after the crisis, with data and so forth, is you're getting a Sharpe ratio of 0.7 on the model, in the model, right? In the market, you get a Sharpe ratio of 0.9, even if after you short, right? So the life has been kinder than the model. The model here acts as a way of testing your ideas to see whether all this nonsense that I told you is actually, You know, it's a way of using a model to look at what are good trading ideas or not. And Andrew Papanikolaou, I didn't ask him to do that, but he came up with this weird graph that is all the possible ETN scenarios and then the one that actually happened in history. This is all the possibilities. So if you really look at these measures, they have a negative expectation, but not as negative as the real market. The real market was very kind to us. 10 minutes, 10 minutes, easy. Okay, now here quickly, I have 10 minutes. Now this is for the ultra experts. Now I go and I say, I don't like my processes X. I like the shape of the yield curve. I just want to work with the yield curve. So I go back to my model. I have the log of V, the derivative. I write these equations. I apologize for this. I know that I can invert this and get X as a function of the level and contango, right? So then I can stick them back in my equation and then get an equation for the ETF, which is sensitive to level and contango, so that I can do dynamic trading. See, when I buy, when I sell. So when you do that, this is the equation that you get. And this is all numbers. So it says the return, the SDE is a 60% vol, local or instantaneous volatility. The other one is a little bit higher because you divide by the rate of mean reversion. And here you see the difference between log, level and expected level, contango and expected contango, negative coefficients, plus a negative mean. These things have mean 0. You have a minus 67 drift. This is an actionable result for quantitative trading, negative drift for high volatility and or high contango. And this is the phase diagram that you get. To answer the question of your question, what happens with what the model predicts is that there's a piece of this, this axis is level of volatility at 30 days. This is level of slope of volatility at 30 days. This green line is the line where the drift is 0. This means negative drift, so you should short. This is positive drift. So positive drift, when do I get positive drift? Well, I feel I never get positive drift. But you know, the point is that perhaps if vol is very, very, very low, you know, like in the like VIX at 9 or 8, that's not the right time to make a big trade, because maybe then mu will be by mean reversion. You see, this might go up. But most of these dots are actually realized. So most of the time you're living here. And most of the time, and dynamic trading can provide Sharpe ratios as big as 1.7. You can check that on your own. So this phase diagram says, where am I? I'm here, I should go long. I'm here, I should go short. And I get the drift. In reality, you have to take a buffer. I'm not going to tell you how to use this in practice, but you can imagine that you don't want to be changing signs across the green line. You have to have a little safety, right? Epilogue, now I have 5 minutes. My epilogue is going to Europe. Mr. Avellaneda goes to Europe. He decides to go to Europe, you know, doesn't like the US anymore. So now he goes to, and also this has another lesson. I'm not going to repeat the same thing. The lesson is that you can do a lot of stuff empirically here that I have not done. For example, you don't have to short ETFs all the time. You can short ETFs only when contango is big. That was the idea of this graph. This graph, you know, when the contango is big in this region above, the region above here, this is the good, sweet region is here. And here, when contango is too low or negative, you don't want to be in this market. So I hope I'm giving you things that you can test, right? The idea of a talk in my life, what I like to do is I want to give you talks that you can reproduce. Everything here is reproducible. There's no hypothesis, right? So VSTOXX is a European counterpart of VIX. It's based on Eurostoxx 50. The futures are copied from the American futures. They're done by Eurex. And first observation, see, that's why I love data. First observation, VSTOXX is always higher than VIX. Why? Please, European people, tell me. Maybe you guys are more scared of life. You know?
There's different European options and American options.
There's difference between, you mean European style or American style? No, everything is European style. It's variance. It's the variance. It's the Eurostoxx. It's not, that's a good guess. Is that the reason? I don't know. See, that's how we need more smart people in the audience.
We're more cautious.
Huh?
We're more cautious.
You're more cautious. See. VSTOXX is the volatility extracted from the 30-day implied variance of Euro Stoxx options. Euro Stoxx 50 options. Euro Stoxx 50 is a more concentrated index, but it's also yeah, but it's blue chip. You know, what's more volatile? Dow. You know, and besides, you know, I think I think that fear is fear. I think that the Europeans are more cautious than the Americans. Okay, I want to finish my talk. I want to finish my talk because I'm going to be kicked out. So I don't want to be kicked out. So Europe is more volatile. The VSTOXX is 20%. We are 15%. Okay. Now, European volatility ETNs. In May 2017, there's a company that launched European volatility ETNs, and there are others that trade in life, you know, in London, blah blah blah. Okay, they have no liquidity. But I studied the contract, I studied the prospectus, and in the prospectus you get weights, and the weights tell you that they're very much copied on VXX and VXX and XIV. Okay. So what do if I short them? What if I simulate shorting them since inception? Well, here is another thing. Hey, Europeans, if I short your ETF since their inception, I lose a lot of money. I make money at the beginning with huge volatility, and then I lose money until Brexit direct. And then I make a little money after Brexit. So the European volatility has to have something different than the American volatility market. It's maybe the European Union, maybe the Greeks, you know, but we have a model. And we already know that we love to short things when contango is high. But so that means that unless you do dynamic trading, you don't come back from Brazil rich, you come back from Brazil poor. That's the difference. I don't like to come back from Brazil poor. So I have to do something. So that means you have to do dynamic trading. Do you use that model? Well, let's first try to do some simple dynamic trading. So first of all, you know, you have to build a curve, yeah, and then you look at the slope, contango, 30-day slope from spot. So you look at how this contango moves. Maybe this is some kind of event. So it's moving around zero. It's mostly positive, but you have some negative contango spikes here, yeah? 20% negative contango, it's not good. So you see that, and I call this indicator, this is not the derivative, it's a chord, because I thought it was easier to explain. So I came up with this idea, me and Xin Huan Zhang, we came up with this idea of thresholding. You say, like, you know what, in the market, I'm only going to trade if the previous day chord, the previous day slope, is larger than a threshold. And therefore, my return for investment will be the heaviside function, 0 or 1 if this happens, multiplied by the return from t minus 1 to t, from the EVIX or rolling futures or whatever. Let's do that. Well, I told you the answer here. You get Sharpe ratios. If you have to have a big threshold. You want to really trade this stuff when it's in deep contango. So when it's in deep contango, you just sell the baby, and you hope that there are no jumps, that that you can get out, if you like. This one signal, one thing, this is not your whole life, that you can get out when the curve flattens. When Marine Le Pen starts becoming important, it's time to go. Is it time to buy? I'm not sure, but it's certainly not time to sell. When Marine Le Pen disappears, when Trump goes on vacation and play golf, then you short. Okay? Those are the two concerns that I have. Then this is a back testing, but of course one always shows curves going up. But I believe very, very strongly, that this is real. I believe that selling volatility is a way to make a living. And I believe that you can get good at it. It's like soccer. You know, you can play like Friburguense or you can play like Botafogo. You know, Friburguense never wins. Botafogo wins championships. That depends on how skillful you are, how good you are at doing this stuff. This is just a slight tour. These are the references to the papers. You can take a picture of that if you want. And I thank you very much for your attention.
Thank you very much, Marco. So.